Hello there, welcome to another live webinar with us from Phillip Futures. And what will we be speaking about today on this lovely Tuesday evening? We are going to discuss the framework to analyze gold and the Forex market. With us in the studio is none other than professional trader Kar Yong. And what will Kar Yong be speaking about? Let me deep dive into some of the talking points that Kar Yong has laid out for us. He will be sharing some actionable strategies which you can use to identify opportunities in the gold and forex markets. And he'll also give you a heads up of potential opportunities in gold, forex, and indices that you may want to keep a keen eye on. And he will also share the Soros's method of understanding the FX market and trading opportunities going into 2022. That is what I shared earlier, touching on gold, forex, and indices. Kar Yong will also briefly touch on the framework for identifying potential opportunities in gold. The focus very much seems to be on gold today. Let's find out more from Kar Yong as to why this is so. Before I jump into the webinar proper, can I just do a quick check? Can you hear me loud and clear? If you can, please navigate to your question box located on the bottom right of your control panel and type a yes in the box. All right, thank you, Andrew, for confirming that the sound is good. And Kar Yong, if you're all set to go, I can hand over the reins to you.
All right. Great. Okay, so everything should be working fine. Cool. Okay, so welcome to today's webinar over here. Okay, so for today, we'll be sharing with you a little bit into the framework of the macro perspective of how we look into the FX market. Okay, I believe that if you're here, you've been trading for some time, you've been investing for some time, you're pretty much familiar with some of the common framework to analyze the market, such as fundamental analysis, as well as the technical analysis portion. Okay, so today we'll be looking at a broader picture. You can call it the macro analysis framework. Okay, so we'll definitely look at the big picture, and then for the remaining time, we'll zoom in into individual opportunities that I feel would be worth for you to actually keep a very close watch, especially going into next year. Okay, and in fact, if you're monitoring what are some of the events that are happening this week, you do realize that tomorrow, okay, depending on the time zone, of course, tomorrow midnight in Malaysia and Singapore, we do have the upcoming FOMC meeting. Okay, and what we're going to discuss today do have some relation as to what's going to happen in the FOMC here as well. Okay, so from today's sharing, you'll be able to better understand the macro perspective of looking into the financial market, as well as how we can apply those frameworks to help us in our trading and investing. Okay, I'm pretty sure you guys would have questions along the way. Okay, I've also designed it such a way where I've some time at the end of today's sharing to allocate to Q&A. Okay, so if you have any questions, just feel free to type it into the chat box. And then after that, when we're done with the sharing, I'll be able to look at your questions and answer them accordingly. Okay.
Hey, Kar Yong, would you be able to minimize the right panel on your screen? And so you can analyze the slide. We see the toolbox. Yeah.
This one.
Yeah.
All right.
This is good. Thank you.
Yep. Okay. So before we get into the specific opportunities that I'm personally looking out for, I think first we'll probably need to understand the big picture, the macro perspective, which we call the framework. Okay. So first off, to understand a little bit over here. Okay, when we talk about the financial market, when we talk about currencies, when we talk about Forex, okay, they're essentially money, and money over here, a lot of times we can't understand it in terms of physical cash, right, where we look at like notes, coins, and things like that. Okay, but in the financial market, we need to also be aware that there's this thing called credit. Okay, and I would say majority of the financial system right now is actually run on credit, and not so much on like cash. Okay, and when we understand this credit framework, okay, you kind of understand that why this is so important. Okay, so money here, basically, a quick introduction about it, serve three primary functions. Okay, I think this shouldn't be foreign to most of you. Okay, one is of course as a store of value. Number two is the medium of exchange, and of course the third one here in terms of the big picture macro perspective, it's a unit of account. Okay, and of course most of the time for us as public, okay, we tend to use money as a medium of exchange as well as a store of value. Okay, and exchange rate over here when we're talking about Forex, okay, are basically driven by supply and demand. Okay, and I would say almost everything in the financial market is driven by supply and demand. Okay, but of course the supply factors and the demand factors can be very different in various markets. So when today we want to understand the FX market, the supply and demand in the FX market can be kind of categorized into two big categories. One is what we call the fundamental, okay, which is basically what we understand in terms of fundamental analysis in the FX market, right? And the other one is, broadly speaking, is speculative in nature, okay, which is where traders look into it, investors look into it. Okay, and within the fundamental category of looking at currency market, we also then have the supply side and the demand side that affects the fundamental forces. And then in the speculative side, of course, we also have the supply and demand. Okay, so over here, fundamental, what we are referring to in the FX market are basically our trade balances, in terms of fiscal policy by the governments, as well as monetary policy from the central banks. Okay, so why when we when a certain central bank kind of like put off a certain policy, why is there an impact in the currency market? Is really because of the fundamentals, supply and demand playing out. Okay, and of course the traders would then look into the fundamentals and make some speculative decision. Okay, so there are always these two forces kind of playing out in the financial market itself. Okay, and this understanding of fundamental is also very important because especially from the transition of where we are right now going into 2022, because we are in the process of moving from a very loose financial environment towards a tightening process, right? Towards a tightening financial environment. A majority of the central banks right now, especially on the developed market, are moving from QE, okay, which is quantitative easing policies, towards tightening policies where we see tapering, and then potentially interest rate are starting to hike going into next year. Okay, and of course all this are very important, but the most important central banks that we want to keep an eye on is definitely the Federal Reserve, okay, because the US is right now is still the global reserve currency. Okay, so I'll dive a little bit into this aspect here as we progress. Okay, but generally right now I want you to at least understand like fundamentals. We basically look into the trade balances, okay, as well as the fiscal and monetary policies that can affect a currency. Okay, in terms of speculative, as the name and the term suggests, right, it's basically just traders and investors, right, kind of like making certain decision that affects the demand and supply of a currency based on what they think the future value of this currency is going to be. Okay. So for example, if today we expect the dollar to strengthen maybe 6 months down the road, 1 year down the road, then of course the demand for dollar will going to be increasing for the short term, okay, because traders will want to buy and hold into dollar with the future expectation that the dollar is going to rally, okay, and vice versa. Okay, so over here to kind of simplify it, right, we can kind of categorize the supply and demand for FX market into these three things. Okay, first off, first off over here is trade, right? And this one here we're referring to trade balances, not our retail trading, but global trade. Okay, so it's more of like whether we have a surplus or deficit, right? And that will kind of affect the currency supply and demand. The second category here is non-speculative capital transactions. These are mainly your fiscal policies, your businesses, foreign investors, and things like that. And the third one here, of course, is speculative capital flows. Okay, these are mainly traders and investors playing out. Okay, so this is a very broad picture for you to understand kind of like what can affect the FX market in the supply and demand side, and in relation to that, what can affect the prices and the movement of currencies. Okay, so over here, when we are looking at FX, okay, a lot of times for the short term, we focus on speculative forces. Okay, when we mean short term here, we are looking at, you know, as short as within intraday towards maybe a week or even a month. Okay, when we are looking at a fundamental of an FX of a currency, it's definitely going to take time to play out. So that is what we call more of the longer term, right? 3 months, 6 months, up to 1 year. Okay, so for us as retail traders, most of the time we're going to focus on speculative capital flows. And basically, these are where we as traders and investors are buying and selling currencies without any underlying asset. Okay, so capital flows over here. At the end of the day, what we want as traders and investors is to look for profits. Okay, and we are always in search for the highest total return. Okay, of course, today, if we are only trading on FX, then naturally our only tool to really make money from the financial market would then be FX. Okay, however, you need to also be aware that there are more than just FX in the entire financial market. Okay, we have equities, we have bonds. Even within equities, we have various kind of equities. We have the emerging markets, we have the developed markets, and then we can break it down into many different categories. Similar here in bond, right? You have corporate bond, you have government bonds, and then we have the FX and things like that. Okay, so in the entire scheme of financial market, there are many tools and asset classes that an investor and a trader would be able to access to. Okay, so at the end of the day, when we talk about speculative capital move and capital flow, we are talking about not just within the currency and the FX market. Okay, we're talking about the entire financial market. As a trader and investors, we are always looking for the highest return that we can get. Okay, whether is it from equities, from bonds, from the FX, etc. Okay, so the total return, if you are talking about FX over here, of course, is number one, okay, the exchange rate differential, which is a price. Okay, so if today you expect euro to rally and the dollar to drop, then the exchange rate differentials of euro dollar will go up, and then we can make money from that. Okay, of course, from our perspective, if you're short-term trading, the interest rate might not be a huge chunk. Okay, however, if today you're longer-term investment, you're investing in foreign asset, okay, interest rate is going to play a role. Okay, because if today you're going to invest in, let's say, Japanese yen, which is a negative, close to zero interest rate, you're going to lose out on that. Okay, so that is something that's going to affect that as well. And of course, the local currency capital appreciation is going to have an impact. Okay, so this is more of like giving you a broad understanding of what can affect the FX. Okay, so of the three, exchange rate is the most important one because you know, if today you're trading the FX market, you know that prices in the FX market kind of like volatile and it can fluctuate quite frequently. Okay, so the movement of that can of course by far beat the interest rate difference, and therefore most of the time if you're trading short term, interest rate are not that important in the FX market. Okay, so in the short month, exchange rate are driven by speculative flow. Just now we mentioned that, right? And in the longer term, that's where the economic fundamental really plays a dominant role in the FX. Okay, so this is the part where a lot of times traders, especially retail traders, would tend to say like, which one is more important? Is it fundamental or is it technical? To me, I always say it's best that you understand both. Okay, so that you have a comprehensive and holistic understanding of the FX market. Then when you make a certain trading decision or when you're analyzing it, you'll be able to fully understand as well as to make a decision and a choice whether you want to be focused primarily on TA, technical, or then fundamental, or you want to do a combination. Okay, so today we'll definitely touch on both as we progress. Okay, we'll definitely look at the technical side of things as well as to understand the fundamental, right? Because tomorrow we have the FOMC, and understanding how the FOMC decision can affect the currency and then the global financial market, that is actually on the fundamental aspect. Okay, so this is where the dynamic tension between these two, okay, that causes the fluctuation of FX, right? So both the fundamental as well as speculative. Okay, so the idea over here is, I think this one is pretty straightforward. Okay, but for those of you who are very new to trading, the idea is when the exchange rate or the price of an FX pair starts to move, that's where it starts to gain attention, and the speculators is where starting to come in. Okay, and they are going to start to bet on the trend to continue, and vice versa, right? If the exchange move kind of drop and then price starts to fall, that's where speculators are going to bet that it's going to continue falling. Okay, and over here to talk a little bit about human psychology, right? This is very true in the FX market. When the market in currency starts to trend, okay, you tend to observe that it has a nature of trending in an extended duration. And then after that, it will go into a range-bound environment and it will be consolidating for a certain period of time. And when it starts to break off, okay, so it can either trend up or trend down. It tends to be elongated as well, right? The duration of which it tends to trend can be very long. Okay, so the idea over here is if you are trading on an FX market and you're looking at least a mid to long term, somewhere towards like a swing or a position trade, then you need to understand that when it starts to trend, you want to really capitalize on that move. Okay, and what can cause the trend to happen is primarily going to be a fundamental shift, and then the speculative, we're going to come in, and that's where it's going to elongate that entire duration. Okay, so this whole part here, why is it so important to really understand it at this moment? Because as I mentioned, we're in the transition of a fundamental shift, potentially going into 2022. Okay, so a lot of the opportunity, I would say, okay, would really kick in starting next year. Okay, and if today you're able to prepare yourself for that, okay, that's where you're able to capitalize on and maximize, okay, on the opportunity and ride on the trend as much as you can. Okay, so over here, of course, not every trend is going to continue, right? So the idea is that, as I mentioned over here, the exchange rate diverges too far from the fundamental, and then that's where we're gonna have like a reverse, okay? And you can see on the technical chart as well. Okay, so over here, just to share with you the entire framework, okay, today I kind of like introduce it to you, okay? But if today you're interested to go and dive deeper into it, then you might want to look up this book here by Javier Gonzalez, right? The title of the book is How to Make Money with Global Macro. Okay, and within the book, he did kind of like cover a principle, a paradigm called the core and peripheral. Okay, it sounds very complex, but today I'm going to give you a simplified version where you can kind of understand it from a layman perspective and more importantly, apply it. Okay, so the core and peripheral paradigm is basically looking at which is the main market right now. And naturally, because the US dollar is the global reserve currency, the US right now is going to be determined as the core, okay? And the peripheral is basically anything other than the US market itself, okay? And in a very simple way, okay, I'm going to give you some text to support the understanding of it. But in a very simple way, the whole paradigm and the framework over here is that we talk about money flow. Okay, so if the US, which is the core, okay, is going to be outperforming the other market around it, which is the peripheral, then demand for US market is going to be increasing, right? Because again, traders and investors are always looking for the highest total return. Okay, so if the US is outperforming, then that's going to be the center of attraction, and money flow is going to go into the US market. Okay, and just now, as if you can't understand, money tends to flow from one to another, and money itself basically revolves around cash plus credit. Okay, so when money flows into the US, it needs to come from somewhere. Okay, and in this case, in the paradigm of this, it's going to come from the peripheral. Okay, so it's going to be your emerging markets, you know, other than the US. It's going to be flowing into US, and then other markets are going to see the price drop because of the demand supply factor as well. Okay, so in this paradigm, the global currencies can be divided into three, okay, which is of course the reserve currency right now is still the US, So that will be the core. Okay, and then you have the hard currencies. Again, very different terminology, but generally we call it safe haven, right? So these are your currencies such as Japanese yen, as well as Swiss franc. Okay, and normally during a risk-off environment, this kind of currencies tends to strengthen. Okay, and then of course you have the soft currencies, which is also what we call commodities currencies, right? So you have like Australia, you have your Canadian, you have your New Zealand. Okay, and during risk-off environment, these are the currencies that tend to weaken. Okay, so if you can't understand a little bit in terms of risk on, risk off, safe haven currencies, risk currencies, these are just different terminologies that are being used in the book. Okay, so the core right now is definitely still the US dollar. Okay, and then you have your safe haven, which is also known as hard currencies, and then you have the commodities currencies, which is known as the soft currencies. Okay, so over here, okay, just now I briefly mentioned, right, global capital, okay, are basically in search for a highest return, right? So we don't really care, like, is it the US market or is it the emerging markets? But as a trader investors, I just want to know which part of the financial world am I able to get the highest total return if I were to put my money there. Okay, and that's basically the concept of money flow. Okay, so when the dollar appreciates, right, perhaps due to fundamental forces, perhaps due to speculative nature, okay, it's gonna have kind of like a vicious cycle. Okay, because if the market in the US is gonna be very attractive and dollar itself is kind of paying off a higher interest compared to other market, the peripheral market, then as an investor and trader, what I'll do is I'll definitely want to invest in the US market. Okay, and if today I want to invest in the US market, naturally I'm dealing with FX because I need the US dollar. Okay, when I exchange it for US dollar to invest in the US market, the demand for dollar tends to pick up as well. Okay, and that itself would generate a feedback loop that pushes the dollar higher, and then as Forex traders, they will start to see, oh, the price of dollar starts to appreciate, and I'll be able to kind of like benefit and profit from this price movement, and then they start to come in as well to trade the US dollar, and that kicks off, you know, the demand for US dollar, and then it becomes a feedback loop. Okay, so that's something that you know, I want you to have at least an understanding of what's happening, okay, in the entire financial market. Okay, so we mentioned, right, that money needs to come from somewhere. This is what we call the money flow concept. Okay, so that's where if the money is going into US, it's definitely coming from outside the US, and vice versa, right? If the US is not performing as well as the other market, especially the emerging markets, then money will flow out from the US and it's going to go into the emerging markets. Okay, so over here, this is a quote that I've taken within the text, right? Commodities rise for two reasons. Okay, if you actually keep an eye on what happened last year and this year, commodity prices has been rising. Okay, and there are generally two reasons, or I would say two factors that kind of contributed to that. One is investors' flight to avoid depreciating of the currency, of the reserve currency. Okay, which in this case here, if the US dollar tends to depreciate, price of the dollar starts to drop, then naturally the demand for commodities are going to go up. Okay, the reason is very straightforward, is because commodities right now are traded based on US dollar because it's still the global reserve currency, right? So you can actually observe last year and this year, okay, commodities has been shooting up because of the fear of inflation. Okay, and inflation is essentially the devaluation of a currency. Okay, a lot of big words there. But basically, inflation, if you understand it from a very layman way of understanding, is the price of general goods and services are rallying, right? And what does that mean is that $1 today is going to worth less in the future because of inflation. And if you take a look from a currency perspective, your value of that currency is basically dropping. Okay, and that's why we say inflation is essentially the devaluation of a currency. Okay, so last year and this year, you do realize that commodity prices are rallying because, again, the fear of inflation, it will drive demand for commodities, because with inflation, the reserve currency value starts to drop. Okay, that's the one reason. Now, the second reason over here is that producers are increasing their prices because, okay, again, these commodities are traded in the US dollar. Okay, so if US dollar are devalued, businesses, producers needs to kind of balance off the exchange rate differential, okay, and they're going to increase their prices. Okay, so these are generally the two reasons. Okay, and from there, okay, due to this kind of dynamic, right, where we talk about money flow, Gonzala actually points out that on average, these cycles are going to be happening at a call longer than the other markets. Okay, what this means is that when the US are trending, okay, when the US market is strong, is outperforming the rest, the duration of which this will happen is going to be way longer than compared to, let's say, other markets are outperforming the US. Okay, so when we refer to the core here, at this moment it's still the US because the US is the global reserve currency. Okay, and if you take a look at it, the S&P market has basically been rallying for the past decades or even longer than that, right? And every time we have a recession, you realize that yes, the market come down, but it's not going to come down very long. Okay, and then after that, the market will flow back into the US and it's going to outperform again. And the duration of that, the trend of that is going to be way longer than the other markets. Okay, so cycles are longer at the call, okay, when the currencies are appreciating compared to when that US dollar is depreciating. So in other words, okay, if the US dollar is strengthening, you do realize that the US market, the financial, the equities market, money flow going into the US are going to be way longer compared to when the US dollar is depreciating, right? And money is coming out from the US. Now, there is that short period of time last year when money is actually flowing out of the US and going into the emerging market. But after that, we start to observe that money is flowing back into the US. Okay, so later I'll share with you a little bit what are some of the indicators, I would say, right, that you can use to track what is happening right now and how you can prepare yourself. Okay, but right now, using this PowerPoint slides here, I want to give you a broad picture of this entire framework, and then we'll look at to some of those indicators and charts, then you can appreciate them. Okay, so going into 2022, right, what are some of the things you really want to take note of? Okay, just now we mentioned this is going to be very important because we are in the transition from QE going into tightening. Every time we have this cycle of shift, okay, we need to pay very close attention to that because any imbalances and that causes by the Fed, if they don't move it properly, we're going to see a rather drastic shift. Okay, so over here, you know, how the Fed is going to respond to the upcoming monetary policy. Are they going to be very, very hawkish, or are they going to be cautiously hawkish? Kind of will determine whether the US market is going to be benefiting for the next 1 or 2 years, or okay, the emerging markets are going to be benefiting from it. Okay, so that's why tomorrow or Thursday, FOMC is definitely very, very important. Okay, if today, okay, you want to understand a little bit in terms of like George Soros' framework, okay, he has this terminology called the benign and the vicious cycle. Okay, the idea again is just about whether US is going to be benefiting, okay, or the emerging markets are going to be benefiting. So it's kind of like different term, similar concept. Okay, so we have like the core, which is reference to the US, right? And if today the US is going to be benefiting from it, we'll say it's a benign one. Okay, it's a benign circle. If today the US are not going to be benefiting, but the emerging markets, the peripheral markets are going to be benefiting, then we'll term it as vicious cycle. Okay, so it's kind of like different term, but they essentially means the same thing, right? Whether US is going to be benefiting from it, or are we going to see the emerging markets outperform? Okay, so over here, we need to track a few things going into next year. Okay, first up, of course, is the Fed monetary policy. Okay, the second instrument you want to keep a very close watch is definitely the US dollar. Okay, because if today the dollar were to appreciate, okay, we can actually continue to expect, especially the US outperforming, and we can continue to expect general equities to continue its bull run. Okay, I know a lot of traders are calling for the bear market to kick in, but if you consider last year March, okay, 2020, somewhere around Feb and March, we kind of had like a very big dip, but it bounced back off in a V-shaped recovery. Is that considered a bear market? Might not be kind of like termed as a bear market because it's kind of like a V-shaped recovery, right? It's not very long. It's probably just about 1 month, right? However, that itself can be a sufficient reset for an entire financial equities market, and it can be done, right? Because a lot of times we have the understanding of the equities tends to go into a bear market, goes into a recession every 7 to 8 years, and the last crisis that we had was in 2008. Okay, 2008, right? And then if you go and calculate it all the way until 2020, it's kind of like extended. Okay, and some traders kind of say that, oh, 2020 is not really a bear market. Okay, so again, we're expecting another bear market maybe in next year or 22-3. Okay, but whether that's going to happen, of course, none of us would know. Okay, but there are some guidelines or say frameworks to kind of give us some indication of it, and today's sharing here is going to be one of it. Okay, previously I recall we did talk about macro liquidity as well. That's another framework that we can use to kind of understand whether are we going into a bear market. Okay, so right now, understand that if today the US market is going to outperform and we continue to track the US dollar, if the dollar is going to continue to appreciate, then we can continue to see bull market, a bull run in 2022. Okay, so over here, okay, if the market in the US is going to be outperforming, we're going to see a bull run in the US, then emerging markets are likely going to be suffering. Okay, they're not going to be performing as as good as the US, and vice versa. Okay, so over here, okay, if today, okay, if it's going to be not good in the US, then our concentrated focus is going to be in the developed markets. Okay, and one of the interesting developing markets we are looking at is going to be Mexico. Okay, I'll share with you some charts later on. Okay, so if it's going to be in the developed markets, then definitely it's going to be in the US. If it's not going to be in the US, then the next best alternative market here to really keep an eye on is the Mexico market. Okay, so quite simply put, okay, depending on which is going to be outperforming, you want to focus on there. And these are not short-term play. Okay, we are looking at 22.2 going into 22.3 as well, right? So for the horizon of 2 years. Okay, so if today the US is going to benefit, then of course we're going to look for stocks that will benefit from higher rates. Okay, the reason is because we are looking at a tightening process. We are looking at interest rate hiking in 22.2 and 22.3. Okay, so not all stocks are going to definitely be benefiting at the same rally. Okay, but what you want to pay attention to is stocks that can still perform well when we are in a rate hike process. Okay, and of course, not necessary that we're going to focus too much on commodities, right? Commodities play is more on 2020 to 22.1. Going into 22.2, okay, it might not be so much of a commodity play anymore. Okay, and of course, if you're looking at currencies, we definitely long the dollar, right? However, if it's not going to be good for the US, then it's going to be exactly the opposite. Okay, we're going to look into emerging markets and some of the commodity linked asset because the dollar is going to drop. Okay, and that's where we want to focus on the peripheral markets. Okay, yeah? So that's the broad framework that I would like to share with you today. There are quite a bit of like different terminologies and things like that. But if you want to simplify it, to sum it up, okay, think of it as money flow. Okay, if today the US market is performing well, money is going to go into the US. Okay, all other markets are not going to be performing as well as the US. If the US is not performing and the emerging market is performing well, the money is going to flow out of the US. Okay, and the US market is going to suffer, the dollar is going to suffer, and you want to focus your attention on other markets. Okay, so with that, let me bring you over to the chart. Okay, and share with you some of the things that you can use to kind of track this. Okay, first up over here, you want to look out for, let me change to the line chart. Okay, you want to look out for this where if you're using TradingView as a charting tool, you can key in this SPX over EFA. Okay, and then you just type enter, right, just to show you that. Okay, what is this tracking? Is basically it's tracking a ratio comparing the SPX, which is the S&P market, versus the rest of the world. Okay, which is your EAFE ETF. Okay, so at this moment, right, just to show you what we are seeing right now at the current chart. Okay, let me change this line so you can see clearer. Okay, the ratio is going up. Okay, so what this means is that if you are looking at this as a ratio, SPX, okay, against EFA, okay, if this price is going up, what it means is that SPX is rallying way more than your EFA. Okay, so this means that the US market right now is still outperforming the rest of the world. Okay, so as long as this is still going up, right, you want to still focus on the US market. That's why if you consider last year and this year, the S&P is basically hitting, record gains, even in such a crisis. Okay, because every money is still flowing into the US at this moment because of its outperformance. Okay, so this indicator, okay, this ratio here is very important to keep a very close watch going into next year. Okay, now something to keep an eye here as well. Just very quickly give you guys a refresher for those of you who kind of understood the macro liquidity environment. Okay, for those of you who never heard about this before, very quick introduction to it as well. Okay, so over here when we talk about macro liquidity, we're just basically referring to how liquid it is in the financial market. And when we mean liquid, we are talking about money flow again. Okay, and because the Fed is still the major central bank, US is still the global reserve currency, it controls a big chunk of liquidity in the financial market today. Okay, and the Fed here, if you talk about today's context, is looking to do tightening, or in fact, right, they're already in the tightening process by doing tapering as well as potentially a rate hike in 2022. Okay, tightening. Okay, so when the Fed is doing this, they are actually reducing liquidity in the financial market. Okay, and when liquidity is being reduced, okay, what is going to happen is that money is going to be sucked out from the financial market, and when money, okay, and when there's less money, of course, demand is going to be reduced as well. Okay, and that would then cause equities market to either correct, okay, or fall. Okay, so this is the framework of macro liquidity. Okay, so over here, what we want to understand and be very aware of going forward is, of course, this tightening process. Okay, the pace of how fast the Fed is tapering, okay, or potentially hiking rate will have a major impact into this itself. Okay, because this move here is going to have a major impact across board. Okay, and not only just your FX market, but in terms of equities, your bonds, your commodities, everything is going to be affected because of the US dollar. Okay, so we have this framework, combine it with today's framework over here, where we look at US market versus the peripheral market, okay, using this ratio of SPX over EFA. Okay, so if today the Fed starts to continue to, be very cautious in its tapering process, cautiously hawkish, and we continue to see this ratio here, keep going up. Okay, of course, it's not going to keep going up straight line. Okay, but if it's just going to do a little bit of sideways and then keep going up, you want to still focus on the US market. Okay, however, if you start to see the opposite, okay, US Federal Reserve starts to talk about, they need to increase the pace of tapering. Next year, we're going to probably see 2 rate hike. We'll probably shift into a stagflation mode, okay, and if this ratio here starts to turn, okay, you want to then shift your focus out of the US into some of the emerging markets, okay. So this is one ratio that you definitely want to keep a very close watch. Okay. Now the other one here you want to keep an eye on is the ratio of SPY, or you can look at SPX. Okay, basically you're looking at the S&P market against XLU. Okay, XLU are basically your utility ETF. Okay, so this ratio we are just basically tracking between the general equities market versus the utility sector in the US, which one is performing better. Okay, if the price of this is coming down, okay, it's telling us that utilities are outperforming the US general market. Okay, so this can be coming down, this can be going up, or the utilities can be going up way more than the SPX. Okay, now generally when this ratio is coming down, it's telling us that the investors and traders, the market, are moving into a risk-off environment. Okay, which means that they're actually pouring in their investment into utilities sector during this tightening process. Okay, and when that happens, you want to be very, very cautious in the general equities as well. Okay, because that means everyone is starting to price in a risk-off environment. They're investing and they're putting their funds into utility sector. This sector here is outperforming that. Most of the time when you see this come down, okay, we can potentially see a bigger correction or dip in the general equities. Okay, so this is another indicator that you would definitely want to keep an eye on moving forward going into 2022. Okay, we are starting to see a little bit of a dip here already. Okay, and if you're familiar with technical patterns, okay, this is potentially building up as a diagonal or a wedge as well. Okay, and if this is able to break below this pattern, and more importantly this level here, you want to definitely be very, very cautious. Okay, S&P can see a dip back. Okay, now with that, let me just very quickly show you the equities market. Okay, let me bring you back to candlesticks, right? So you can see S&P right now is rejecting off our all-time high that was established earlier this year. Okay, it kind of came and attacked it, but instantly reverses. Okay, as of today, it's kind of breaking off this low. Okay, it's not a sell yet. Okay, but I think the market is basically reacting off for tomorrow FOMC. Okay, so a lot of all this move here are kind of like really dependent on what's going to happen tomorrow. Okay, are we going to see a very aggressive hike, or are we going to see a cautious kind of like hawkishness coming from Jerome Powell? Okay, that we're going to have a very major impact moving forward. Okay, yeah. So I would say don't. Right now, it's very difficult to really tell you whether to buy or sell, which direction to focus, because we want to first look at the fundamental play on Fed. Okay, so if I were to plan out the scenario for you over here, okay, this is my personal top flow. Yeah, scenario A, okay, the Fed is cautiously hawkish. Okay, they're definitely going to be hiking rates. Okay, the question is how fast they're going to hike it. Okay, so cautiously hawkish means that they're going to be hiking it, but in a very slow pace. They will, use terms like they'll need to see how the economy is developing, then make some decision. Okay, these are all sign of being cautious. Okay, if this is going to be the case, then okay, that's a good chance we can continue to see the US outperform. Okay, if that happens. Okay, scenario B, okay, is where the Fed is just very hawkish. Okay, and that can really throw the market off, and this might cause emerging markets to be outperforming. Okay, and this is the part where if they're very hawkish, liquidity dries up. Okay, US drops in terms of equities, then where would the money flow? It will flow out of the US. Okay, so that's the idea. Okay, so do keep an eye on the upcoming FOMC to kind of make a decision on whether the Fed is cautiously hawkish or very hawkish, and then you want to focus differently. Okay, so just now I also mentioned one of the emerging markets to keep an eye on is the Mexico market. Okay, and for us as retail traders, the kind of like easiest way to be exposed to the Mexico market is through dollar Mexican peso. Okay, unless you have access to like directly into Mexico market, this is the closest, dollar Mexican. Okay, and the beauty about this currency here is that if you play into the carry trade, okay, this is where we talk about interest rate differential. Okay, dollar Mexican has a very big interest rate differential, okay, which means that if today, okay, you sell the dollar and you buy the Mexican peso, okay, you collect interest, and this one here in FX market we call it the swap. Okay, and it can be a very lucrative trade just by looking at the swap fee. Okay, so if you're looking at dollar Mexican, the play here that I'm looking at is not to buy dollar Mexican but only to sell it. Okay, in other words, if today the condition, okay, the framework suggests that the US is not going to be outperforming, but instead the emerging markets are going to be outperforming, okay, then my primary focus, one of it would definitely be on dollar Mexican. Okay, I'll be looking to sell this particular currency over here. Okay, just to give you a perspective of the daily chart right now. Okay, you can see that we kind of rejected off some of these key highs, okay, recently. And if this were to take off moving forward, we have this significant low here once this range is being able to break off. Okay, so the downside is definitely there. These are not short term, these are carry trades, right? So again, one of this opportunity moving forward into 22 to 22.3, okay, if the peripheral market, which is the EMs, are going to be outperforming, one of this opportunity is going to be coming from the dollar Mexican. Okay, you want to look to sell this to collect interest plus the price differential. You can actually also capitalize on that. Okay, so there's one of it. Now, if today, okay, you are focusing on gold, okay, the primary outlook for gold right now, okay, as we're speaking here, is basically neutral. Okay, where in the consolidation phase, it's very difficult to say whether up or down right now. But again, if you use a little bit of a macro framework to guide us, okay, if the dollar today is going to be strengthening, okay, this does not mean the gold will collapse all the way, okay, but if the dollar is going to strengthen, then we can continue to expect gold to drop back towards somewhere around 1680, okay, which will present to us perhaps a short to mid-term play on the downside if the dollar strengthens. Again, that means that US is actually outperforming the rest. Okay. However, if today, okay, the dollar is going to be weakened, then you can start to focus on gold here for the upside, at least for the long run. Okay. Short term, if it's coming down, okay, you want to just primarily focus on short term play if gold is coming down. Okay. However, if gold that means the dollar is weakening, okay, you can look for gold as a long term play. Okay, over here, if you're focusing on gold, I would say, your upside might be limited to previous highs from a technical analysis perspective, okay, back up to 1910 or even up to 2060. Okay, but you can look at similar play in silver as well, okay, XAGUSD. Okay, because if silver, you can see, if silver decides to take off from here, once it clears off its entire range, given that dollars continue to weaker, once it clears off this range, you can see the next target for silver is going to go all the way back up towards $47.80 area. Okay, so for me, I'm primarily looking at long-term upside for the precious metal if the framework suggests that dollar is going to be weakened. Okay, I'm going to look at dollar Mexico as a potential play here as well, for the long run as a carry trade. Okay, however, if none of this is going to happen, that means the framework suggests that, okay, US is still going to be outperforming, US is still going to be strong, okay, dollar is still going to be strong, then what we'll be focusing on is just typical, okay, normal equities market, focus on S&P, and then you will gain from that play itself, okay. So this commodities and the dollar Mexican play is more of if money starts to flow out from the US, the dollar starts to weaken, you can see these trends play out perhaps for the 1 year to 2 years period. Okay, so hopefully today's sharing, I know it's a little bit, you know, complex in a way, but I hope, you know, I explain it as clear as I can, where you can at least gain some insights from it. Okay, yeah, good. Just to quick check, is there any questions that you guys have? Or perhaps, you know, you have any market that you are looking out for and you'd like me to just share my opinion on whatever instrument or market that you're looking at, feel free to also type it in and let me know.
Hey, Kar Yong, we have two questions on the hand. Members of the audience, if you have more questions, burning questions for Kar Yong, please hit down to the question box towards the bottom of your control panel and type your questions in there. All right, Kar Yong, the first question is from Fong. Fong is asking, isn't it given that the US Fed will pursue policies that benefits its own economy, inflation and employment over the rest of the world? Hence, us traders will have to adjust accordingly, correct?
Yes. Okay, it's a mandate that central bank, okay, so generally central banks needs to be independent of the government, and central bank's decision needs to, of course, in a way, quote unquote, selfish and be protective of their own economy. But you know, in today's global context, there's no way the US Fed is just going to be affecting US itself, right? Because as a global reserve currency, the price of US dollar would have a major impact in every other things. So in a way, the Fed would do their very best to kind of like strive for US interests. However, you know, when they are making certain decisions, definitely they need to consider like the global impact as US dollar itself. Yeah. So in a way, you know, when we are looking at the market today, whatever instrument you're looking, because US is the reserve currency, right? US dollar, whatever you are trading, essentially you are trading in some way against the US, right? If you're looking at gold, you're trading against the US. If you're looking at futures market, you're also trading against the US. If you're looking at FX, of course, most of the FX deals with US as well. If you're looking at indices, okay, essentially you're also dealing with the US dollar, right? Because today, if you buy into US S&P, if you want to invest into the actual US S&P, essentially you need to convert in a way to the US dollar, then you can buy and invest into the S&P. But of course, with today's technology, I know a lot of all this back end is being done without us literally going exchange into US and then buy into S&P, right? But because US itself is a global reserve currency, everything we deal with is essentially touching on the dollar, right? And that's where whatever decision that the Fed made, while it's in the interest of the US, it has a global impact. That's for sure. Yeah.
All right, Kar Yong, thank you so much. We have a next question is from Andrew. Andrew is asking, if it's going to be vicious in 2022, should the focus be on soft currencies since the currency will be in demand for commodity purchases? What are your thoughts?
Yeah. Okay. So if let's say today, US are not going to be performing well, right? So emerging markets are going to be doing better. Generally, the US dollar is going to be weaker, and commodities are generally going to be rallying. Okay. I use the word general because it's not going to be 100%. And when commodities are rallying, then definitely the soft currencies are going to be benefiting from it. For example, like Aussie, New Zealand, and Canadian, which is commodity producing countries are definitely going to benefit from that as well. Okay, so of course, if you are looking at FX, then you know, Aussie dollar generally will be rallying, New Zealand dollar rallying, dollar CAD will be the opposite, which is coming down. Okay, and you can also understand from FX perspective is you look at it as a pair. If one of the currencies are weakening, like the dollar is generally weakening, then of course, you know, Aussie dollar generally prices are going higher as well. But for me, I would say if I were to pick one, right? Of course, it's not just going to be only that one, but the reason for me to share with you today in terms of dollar Mexican is because if today, you know, US is not going to be performing as well going into next year and the following year, and the emerging markets are going to be the one that benefit from it, then I would suggest, you know, instead, I mean, Aussie dollar can be a good play, okay, or even dollar CAD can be a good play, but dollar Mexican can be a good play not only from the price movement itself, but also from the carry trade plan, right? Which is you leverage on the interest rate differential, you write on the swap fee as well. So that's the part where I maybe to clarify a little bit, does not mean that you only focus on one, but if I were to pick one to really, you know, focus at, that will be in terms of currency will be dollar Mexican. Yeah, so hope that clarifies a little bit.
All right, Kar Yong, next one is from BK Lee. He's asking, in the short term, next 1 year, can you elaborate the outlook for silver and gold?
Oh, okay. To be honest, it's very difficult for me to share what likely gonna happen from today's perspective to the next 1 year. Okay, but I can share with you in terms of like scenarios, right? I think this mindset going in, looking at the market as potential scenario 1 and scenario 2, it's to me very important because the market are always evolving, right? Because if today I'm going to tell you, I share with you that, okay, commodities here, I'm personally looking to buy, I'm expecting upside for commodities, precious metal, right, gold and silver. But if the Fed comes in and make a certain surprise change or move in their fundamental policy, then things can change very drastically overnight. Okay, so it's very difficult to say, you know, in a 1 year what we're expecting because markets are evolving, especially in today's context where a lot of uncertainty is reversed, right? We have like viruses, lockdowns, economy is being affected, inflation is now here, and then the Fed needs to kind of like tackle this situation. Okay, the economy is not really very good, but inflation is there. Okay, and it's very difficult to handle it compared to, let's say, economy is good and inflation is there. It's very straightforward. So I would say the plan for moving forward is to really plan out for 2 scenarios. Okay, I think this is more important in today's context as compared to maybe some other environment where the economy is very, very clear. Okay, so right now the first scenario over here is if the Fed, okay, is not gonna be overly hawkish. Okay, the Fed continues, you know, Jerome Powell likes to play things very, very safe, right? He likes to say that you know, it's time to hike. He primes the market, get the market to be prepared for a rate hike, but he likes to say things like you know, but we need to see. Okay, maybe if things turns out well, then we'll do it. Right. So in a way, he's giving him that they are going to do it, but they're going to do it cautiously. Okay. So the Fed right now, Jerome Powell likes to do it that way. Okay. However, if it surprises the market by saying that we're gonna, you know, definitely increase our pace of tapering, we're gonna see 2 rate hike next year, then definitely the dollar can shoot up, you know, quite fast. Okay. So I would say if the Fed, again, number 1, okay, if the Fed is going to be very cautious, okay, we can of course expect commodities to continue to rally. Okay, that's what I'm looking out for. However, if the Fed is going to be very hawkish and pushes the dollar up significantly in a very short period of time, then naturally your commodities are going to suffer as well. Okay, so I would say right now it's very difficult because I won't know what the Fed is going to do. But from a technical point of view, if today I share with you maybe gold first, right? This one here, we look at gold first. Okay, From a technical point of view, there are some key levels you definitely want to keep an eye on, and it can help you a little bit in preparing like whether you want to look for a buy or sell depending on how this market breaks off. Okay, so in terms of gold right now, okay, this is on the daily time frame. Okay, so it's definitely not like very short term. Okay, you want to definitely pay attention to somewhere around 1880. Okay, if the market is able to break it off in a very impulsive way, okay, not just tag it and then that's about it, but you want it to break off. Okay, that means something like this. Okay, let me just take a very quick, example. If it breaks off like that, okay, so of course it goes up a little bit and then it breaks off like this. Okay, if that happens, then you have a good chance, means that commodities can continue rallying. Okay, if this does not happen, okay, and let's say we continue to see for the next 1 or 2 months, gold here just continue to consolidate. Okay, in the short run, we can expect this to come down and retag the low around 1680. Okay, so if today you are looking at gold, okay, if you are looking at short-term play, okay, short side, downside, then your primary target is somewhere around here, okay, 1680. Okay, as long as the market remains below 1880, there's a good chance it can continue to come back down towards 1680. That's like one scenario, one plan, one preparation of it. However, if gold today is able to break off 1880 in a very sharp and strong momentum, then you can continue to expect the market on gold to keep going higher. Okay, so what are the fundamental and catalysts to kind of like move the market right now? We won't know, okay, because we need to depend on what the Fed does. Okay, but from a price level perspective, 1880 will be the confirmation for upside. 1680 will be the target for downside. Okay, and I hope through this little technical sharing can give you a little bit guide, right? In terms of whether am I bullish or bearish, we need to see the Fed, okay, and we need to constantly adapt to what's happening. Yeah, so that one I won't be able to give you an answer because it's going to be irrelevant in a very short period of time after I give you my answer, because the Fed can really change things around fairly quickly. Yeah, so hope that helps.
All right, thank you so much, Kar Yong. Before we end today's session, can I just check with you, since you mentioned the Fed, what are the key events that our traders should look out for, or is there any other key takeaways that you want them to take home, take with them today?
All right, I think the understanding on the Fed is, how we look at the Fed and how we trade it together with the Fed, really where you want to take note is first understand what are the market expectation and sentiment of the Fed policy. So in this case here, right now the market is looking at Fed increasing the pace of tapering and potentially 2 rate hike next year. If let's say the Fed does the opposite of it, which is they're not going to increase the pace and they're not going to increase the number of rate hike next year, there is what we call a surprise element, where the market is expecting the Fed to do something, but the Fed can't make a decision that's not in alignment with this expectation. These are usually where we call it surprise move, and that can cause a catalyst in price movement. So this is where you moving forward, right? Not only this upcoming FOMC, but going into 2022, this 2022-2023 is going to be very important because we're in the transition period of changing monetary policies. So you always want to keep track, like what is the market expecting right now? What is the current sentiment versus what the Fed actually announces and actually do? What's the actual action that they do? If there's an in alignment of it, then there's no surprise. You continue to ride off that trend. But when there's a surprise element, that's where the catalyst kicks in, the volatility will kick in the market. So moving forward, definitely this understanding of fundamental is going to be way more important than just technical itself, because as I mentioned, the Fed decision can really shift something and changes it overnight because of a shift in the monetary policy decision. Yeah, so this is something that if you're still fairly new to the fundamental, I think moving forward, you want to definitely pick up more understanding of how monetary policies can affect the entire financial market. Yeah, so that's something that I hope you guys can pick up.
All right, thank you so much, Kar Yong, and dear member of the audience, thank you so much for your questions. The conversation does not have to end here. If you have more questions, just type them down into our feedback form at the end of the webinar, and we will have Kar Yong look into the questions and provide his views. And thank you once again for being a wonderful audience. Do join us for our upcoming webinars. Till then, take care and stay safe. Bye-bye.